I'd love to ask more questions, but I'm out of time.
Thanks, Anthony. Rushanara.
Well, thank you very much. So I've got questions around the future path of inflation, but I just wanted to ask a couple of follow-up questions in relation to the point about a prolonged recession that I think, Ben, you were talking about. So do I take it from what you're saying is that we should expect this recession to be prolonged and deep, or is it going to be shallow? The Chancellor's talked about shallower. He's trying to have a softer landing. It sounds like it could be something quite different from what you're saying.
Well, I mean, as Anthony described, the central forecast, at least, is slightly shallower than others and slightly longer.
Right.
But, I mean, how confident one can be of either of those, I'm not sure. If you look at our central part, I mean, as I say, certainly the length, I don't think one should emphasise too much, because the profile is so almost flat. It's just declining in the latter part of that projected recession. On the other hand, it seems likely, we don't know, we won't find out for 3 months or something, that we could well have had already by the end of this year 2 quarters of negative growth. I mean, what matters for us in the projections is more, the growth relative to the trend in the economy. Mm-hmm. And by those standards, it's not particularly, in the forecast at least, that deeper recession.
Okay, so if it's not that deeper recession, in terms of unemployment, for instance, could you talk us through what you expect unemployment levels to be? I mean, we talked about tight labour market, but there will be some unemployment. How bad is it likely to be? Or is it likely to be less bad than before? No, that's still bad.
Well, again, one has to take care to think, looking at a forecast conditioned on the steep rises in interest rates that were there at the time of the November report. Mm. And you've seen the unemployment numbers, they go to 6. In the central forecast, could be higher, could be lower. And I can't remember what the peak is in the constant rate.
5.
Yeah,
5.1.
So, there's some rise, but it's not, say, the rise in the early 90s recession where unemployment went up to a lot higher.
Mm-hmm. I think there's also, if you don't mind coming in, I think there's also an interesting question here, because certainly, I mean, I speak for myself when I go around with our regional agents, the labour market is number one story firms want to talk about, and has been for a while. I think still firms, and I would say I was in North East and the North West yet last week, I think firms are still talking in terms of it is so difficult to hire labour now that we are not going to get rid of them, lightly, as it were. There'll be a tendency to want to retain labour because of the difficulty of actually getting them.
So that will make it less. That will make it less of an issue in terms of migration, presumably. Because
it could make the rise of it could push down on the
demand
rise of unemployment. That's the point. It would then probably transfer into somewhat lower profits actually for firms.
Sorry, say that again?
Well, if you think about the labour share and the profit share, it would sort of transfer some of that through the recession away from towards the labour share.
And then turning to sort of the things you were saying about the UK risk premium, there are quite a few euphemisms being used about the period, what happened between end of August and beginning of October. And the numbers you were talking about in terms of interest, 3% end of August, and then up by 6.7, and then
6.2, yeah.
Sorry, 6.2, and then now on to 4.6. So just to try and uncover some of this,
yeah.
Can you just tell us what the UK specific elements were in terms of interest rates, risk premium? But also, yes. You mentioned 20% around inflation, and the strategy for the approach of upward trend of interest rates. That's not going to resolve the issue about the 80%. So, how effective are those tools, do you think, in terms of increases in interest rates? So there's two sets of questions, if you like. The first one about
80-20. So, as we have a chart in the the report, which attempts to break down the sort of contributors to the market interest rate profile between global shocks and UK shocks. And you can see really up until later part of August, or into August, it was all global.
Yep.
And then as a UK contribution comes in quite pronounced way, but it is actually
during the mini budget period, just to be clear.
During that period, that's now coming off, and I say I think.
So, what amount was it that you can attribute to that UK specific element connected to that event?
It's about at the maximum. It was about sort of 170, 180 basis points. According to this, I mean, all these decompositions, of course, are stylized. I mean, they're based on models, so you have to understand. You know, it's not a precise science. And by the way, when we did the 3% and it's 4.6 now, of course, as I mentioned earlier in a question, if you look at the euro area in the US, they've all gone up. So it's not that we've still got 1.6% of UK risk premium left in the. Yeah, it's gone up for the euro and the US.
But taking that into account, what's the UK element?
What now? Oh, it's coming down. I mean, we don't have an up-to-date decomposition of this sort, but I would say now, in terms of, as I was saying to the earlier question, in terms of the differential between our movement and the US and the euro area, it's come down a lot. It's not.
I mean, one other way to judge this, look at the currency. Yeah. And at the time of the August report, I think sterling dollar was, say, 1.19. A dollar was worth, a pound was worth $1.19. At the low, that fell to what, 103 or something? Yeah. And it's now 119 again.
119 this morning,
So the cost of imports during that time, given
that was
not too many come in. I mean, that's a really short period of time. That would be contracts would have been made. But 20% down from the beginning of the year does translate into an inflationary effect. And 40% of food is imported, for example. And so you can see how you have a depreciation passing through that channel.
If I could also add, I mean, we've talked about prices and markets here. I mean, there was a second element to this, that we had very, very illiquid markets and very volatile markets in the sense that they were not trading well.
Okay, I'm just going to you mentioned a list of earlier to the chair's question. A sequence of shocks, COVID, supply chain shocks in Russia and so on. I'm going to bring the B word in again because we haven't talked about it for a long time, and we all know that it's 4.5% before the Brexiteers join the committee. I think there are a few, I'm sure, who will join us. But the point is that with a 4% hit on GDP in the long term, I wonder if you can comment on that. The former MPC member Michael Saunders said this week, if we hadn't had Brexit, we probably wouldn't be looking at having an austerity budget this week. What do you make of these comments? And do you agree that there's self-harm that's been done to our economy, and these shocks that we've had since have made us more vulnerable than other economies?
Yeah, I mean, I think, and we've talked about this a lot of times before. I mean, I think the bank's assessment, and we use this in the forecasts on the Brexit impact, really hasn't changed actually since the sort of work that was done.
Doesn't it in effect compound the problem?
Well, I think I was going to follow up and say, I mean, this work, I think Ben and I did, because I wasn't at the bank at the time, but this was done pretty soon after the referendum. It essentially assumes that there is a long run downshift in the level of productivity. I think of around, it's a bit over 3%, and that at least two of those comes sort of fairly well forward in the time frame. And I think it's fair to say I don't think anything we've seen so far changes our view on that. We haven't changed our view on that so far. So there is an effect in it. That's what I'm saying. Yes, there is an effect. It's not one that, as I say, we've not been surprised by that. I would also add that, I mean, I think it's for Michael to obviously take his own view.
He's a liberated man now, clearly. Carry on.
You said it. I've always, my approach has always been that, as a public official, I'm neutral on Brexit, per se, but I'm not neutral in saying these are what we think are the most likely economic effects of it. But you're a great expert on this subject.
I can comment on that, and clearly I've written a lot about it, so I'm not going to talk about the political choice that was made. I'm going to talk about the economic impact.
But the implications is what I'm interested in.
So it's undeniable now that we're seeing much much bigger slowdown in trade in the UK compared to the rest of the world. That's showing up despite the statistics having been much worse than they used to be, there being a discontinuity, but people have tried to do various ways of trying to correct for those things. There's also the services export side, which we don't have very much contaminated statistics for, so I can say that much more confidently, that there again we're seeing a really strong stagnation. So we're definitely performing below trend in terms of the exports numbers, in terms of the imports, even probably a bit bigger than that. Yep. My own work shows that the simple way of thinking about what Brexit's done to the economy is that in the period that happened after the referendum, there was the very, very sort of powerful, the biggest depreciation that any of the world's 4 major economies have seen overnight, that contributed to increasing prices, reduced wages, and I'm not talking simply through real wages, but also through nominal wages. We think that number is about 2.6% below the trend that real wages would have been on. After that came, sort of soon afterwards and before the TCA happened, came the effects from the uncertainty that was unleashed, which basically translates into reduced business investment. I'm less certain of the FDI effects. Those tend to be very lumpy things. Then what's happening now, we're starting to now see the trade numbers react to the Brexit, the actual TCA impact. And that's what I mentioned in the beginning, that we're definitely underperforming compared to our peers, both in terms of what we're sending to the EU, as well as in terms of what we're sending to the rest of the world.
Okay. I'd like to add on to this, because I look at a lot of firm-level data, and the small firms are the ones that are most damaged, because the cost of the paperwork and so forth is a barrier. It's not just small firms in the UK who want to export, but it is also small firms in Europe who were suppliers and provided competition in the UK market. So there is an inflationary effect coming through the competition channel.
And do you have a sense of what the amount is, the inflationary effect amount is relating to trade with the EU and friction versus, in both directions?
I'm not going to hazard a guess on that.
I can talk about the food price effects. That some excellent students at LSE have done this work, that about 6% of inflation in food prices, 6% is the number which is higher than the rest of the world, as a result of the Brexit impact.
Okay, that's really interesting.
Right now, the inflation rates are pretty close.
Sorry?
Right now, the inflation rates are pretty close.
Yeah.
We had 11.1 in October, the euro area is 10.7. So the timing of these effects is hard to judge. I mean, as Andrew said, we've seen no reason to row back from the estimate we had on the overall impact on real GDP, which is what really matters for real incomes. That we made.
Just going back to Michael Saunders, we probably wouldn't be looking at an austerity budget this week. You can't comment on that. Fair enough. Just one last question, which is about peak inflation. Have we reached it? You talk about it going down middle of next year. Should we expect it to continue to rise in the coming, given where we are in the ONS data?
I think our forecasts are pretty much flat around this level for another 3 months. Maybe it edges down a bit in the first quarter in the central projection. But it's really when these base effects on energy kick in the spring that you start to see the material.
I mean, the energy effect, of course, is now capped until effectively April. I think looking at this morning's number, and going back to what Smarty was saying actually as well, I mean, in terms of food is the area I think particularly watchful, because certainly looking at this morning's number, it actually wasn't much higher than we expected. I mean, we've said consistently it was going to be around 11%. In fact, it was about 0.15 above where we thought it would be. But looking at the components, food was the other thing that contributed.
I'm going to stop there.
Thank you so much, Rushanara. Thank you very much.